we've got an article from Business Insider which covers the pros and cons of a reverse mortgage. If you do not know what a reverse mortgage is, it is a mortgage where the mortgage company pays you instead of you paying the mortgage company. Now, let me let that soak in for just a minute. It's a mortgage that works in reverse. So the payments go from the mortgage company to the homeowner and not from a homeowner to the mortgage company. A reverse mortgage is the type of mortgage that lets you take equity out of your home. They are insured by the Federal Housing Administration, by the U.S. government, if you will. And to get one, you have to be at least 62 years old and either own your home outright or have a very low balance on your current mortgage. They can be useful tools for seniors who want to stay in their homes and turn their home equity into cash they can use each month. And there can be some pretty significant drawbacks, though, to these type of mortgages. So how do they work? When you get a reverse mortgage, instead of paying a mortgage bill each month, the lender pays you, like I mentioned. You can receive your mortgage funds in the form of monthly payments, or you can get an upfront lump sum or get yourself a line of credit that you can spend just like a home equity line of credit. Once you sell your home, move out, or unfortunately die, the loan will become due and need to be repaid, typically out of your estate or using the proceeds from the home sale. The most common type of reverse mortgage is the home equity conversion mortgage, an HECM. It's a reverse mortgage loan. It is where you're taking the equity in your home and the lender is either loaning you an amount in advance or at the beginning, or you are getting monthly payments. So let's just say you had $200,000 in equity in your home. The lender is going to agree that we're going to pay you, and I'm just making a number up, $600 a month every month for as long as you live. And if that $600 a month every month for as long as you live actually exceeds the amount of equity you have in your home, then they continue to make those payments to you as long as you are here. You don't typically make any monthly payments. Instead, when you sell your house, your estate will typically pay it off. If you borrowed, for example, a total of $200,000 and a home that ends up selling for $180,000, you wouldn't owe the $20,000 difference, as we just mentioned. With a reverse mortgage, you'll only owe what your home is worth at the time that loan becomes due. It allows you to stay in your home. In many cases, seniors have to sell their homes and move somewhere else. They have to sell their home and move in with somebody. They've got equity in their home, and they sell their home, take $200,000 in equity using to pay the bills. This allows them to stay in their home and have some additional income on a monthly basis. It's also tax-free money. It's not considered income, so you won't pay taxes on the money because really you're getting a loan from someone, so it's not income. You got to pay it back. So there are no tax consequences on a reverse mortgage. You need to make sure you have enough equity. You'll either need to own your home or have at least 50% equity in your home. You'll have to pay some closing costs. These are cons. You have to pay some closing costs and some mortgage insurance on the loan. Origination fees can be kind of steep on FHA loans. You'll pay interest and fees over the life of the loan. So every month when you borrow $600 and then $600 more and then $600 more, if it's a 6% interest rate, then it's the first month is 6% on $600. The next month is 6% on $1,200. The next month is 6% on $1,800. See how that can add up over time. You can certainly spend all of your equity. Your heirs will have to pay off the loan in order if they want to keep the home. So if you pass away and your estate wants to keep the home, they're going to have to pay it off. Getting a reverse mortgage can complicate being able to pass some equity in your home on to your children. But the reality is, I think reverse mortgages can be a good product for certain people. My suggestion is that you check with at least 2 or 3 lenders. My suggestion is that you talk to your financial advisor, your tax lawyer, or whoever it is that gives you financial advice, and you make sure that that reverse mortgage is right for you. In some cases, it is the only option people have for being able to stay in their homes